Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're discussing the recent decision by the Bank of Canada to hold its interest rate steady at 2.75%, despite calls from some industry professionals for further cuts. This decision follows a pause in rate cuts that began in April after a year of consistent reductions.
That's right, Sandy. The Bank of Canada has already reduced its overnight lending rate by 225 basis points over the past year. This is more than any other developed country's central bank, except for New Zealand. However, some real estate executives feel that more cuts are necessary to boost consumer confidence and stimulate the housing market.
Christopher Wine, the Chief Operating Officer of Equiton, a multifamily company based in Burlington, Ontario, expressed disappointment, saying, "We need another quarter point, not because it moves the dial so much as it builds confidence." He believes Canadian consumer confidence is at an all-time low or a 10-year low.
It seems like the real estate industry is quite divided on this. Some professionals expected the central bank's decision to hold rates steady, but others were hoping for a cut to energize the market. It's a tricky balance, especially with external factors like the U.S., tariffs on steel and aluminum impacting the economy.
Exactly, Steve. The uncertainty surrounding U.S. tariffs is a significant concern. The Bank of Canada acknowledged that it's closely monitoring these effects. They noted that, with the Canadian economy being softer but not sharply weaker, and some unexpected firmness in inflation data, they decided to hold the policy rate for now.
And while the Bank of Canada left the door open for potential rate cuts later this year, they didn't specify any conditions for such moves. Money markets and economists are still anticipating at least 2 more cuts by the year's end, according to Marcus and Millichap.
Indeed, further cuts could lower borrowing costs for commercial real estate investors with variable rate mortgages and those using shorter-term money. However, the cost of borrowing is influenced by longer-term money, like the 5- and 10-year bond yields, which might rise due to inflationary pressures from tariffs.
Phil Soper, President and Chief Executive Officer of Royal LePage, highlighted the importance of maintaining stability amid global trade tensions and inflation unpredictability. He mentioned that in the most expensive real estate markets, sales activity remains stalled, favoring buyers with more inventory and less competition.
It's interesting to note that the Royal Bank of Canada argued that the weakened workforce and cooling housing markets reduce the risk of surging prices if rates were cut. They mentioned that the limited data since April hasn't been entirely negative, which may explain the central bank's cautious approach.
Yes, and Jordan Kemp from Greywood Developments pointed out that while a rate cut would have helped the property market, the development sector is dealing with other uncertainties. He noted that factors like recession fears and monetary policy are influencing where people want to invest their money.
Ultimately, it seems like we're on a path towards loosening monetary policy, but whether it happens this month or next might not make a huge difference given all the other factors at play. It's certainly a complex situation with many moving parts. Today we're diving into a significant topic that's been making waves in the Canadian real estate sector. The Canada Mortgage and Housing Corporation estimates that to bring housing affordability back to 2019 levels, we need to build between 430,000 and 480,000 units annually over the next decade. That's double the current pace of construction, Steve.
That's a massive undertaking, Sandy. The CMHC suggests that this kind of increase would require a revolution in the way we approach housing completions. It's not just about building more homes. It's about modernizing the workforce, increasing private investment, and reducing regulatory hurdles.
Exactly. Aletta Bjorworth, the the deputy chief economist for CMHC, mentioned that systemic changes are essential. He highlighted the need for innovation in construction technology and growth in labor productivity. It's a comprehensive challenge that involves various stakeholders, including policymakers and the private sector.
And let's not forget the financial aspect. The Canadian Real Estate Association reported that the benchmark price for all housing was just under $700,000 last month, which is down nearly 20% from its 2022 peak. However, back in 2019, it was just under $550,000. This shows the kind of affordability gap we're dealing with.
Toronto, for instance, needs a 70% increase in home building over the next decade to address affordability issues, despite increased rental construction in recent years. The region lacks homeownership options that match local incomes, as noted by CMHC.
That's a critical point, Sandy. And it's not just Toronto. Vancouver and Montreal are also facing significant housing gaps. CMHC states that Vancouver needs an estimated 7,200 units annually over the next decade, which amounts to a 29% increase in housing. Montreal faces the largest housing supply gap among Canada's major metropolitan areas.
The situation in Montreal is particularly concerning. Since the pandemic, home ownership costs in Montreal have risen faster than any other large metropolitan area in Canada when compared to local incomes. This highlights the urgency of increasing the housing supply to prevent further affordability challenges.
Prime Minister Mark Carney has pledged to build up to 500,000 housing units annually across the country. However, Toronto Dominion Bank has raised doubts about whether the current government can meet these ambitious targets. They suggest the measures proposed might fall short of closing the gap.
Toronto Dominion Bank emphasizes the need for an unprecedented boost in productivity, which they describe as a revolution in how housing is developed. It's a tall order, but it's clear that meeting these targets is crucial for addressing Canada's housing affordability crisis. Today, we're taking a closer look at Ottawa's latest federal budget and its implications for the Canadian housing market. The government's Buy Canadian policy is set to reshape the landscape by channeling billions into Canadian-made materials and small business contractors. This initiative aims to bolster local supply chains and speed up home building. Steve, what do you think about this move?
Well, Sandy, the Buy Canadian policy is certainly ambitious. It's designed to strengthen supply chains and streamline access to federal opportunities, which should help businesses of all sizes compete more effectively. The government is planning to inject nearly $186 million from Budget 2025 to ensure this policy is fully implemented. It's a significant step that could create fresh opportunities for local lenders and mortgage professionals.
That's right, Steve. The policy, first unveiled last September, will initially target sectors like defense and construction, with a phased rollout to infrastructure and housing projects by spring 2026. The Build Canada Homes initiative, for example, will prioritize Canadian steel, wood, and aluminum. This shift is expected to benefit local builders and suppliers, potentially speeding up project timelines.
And it's not just about materials, Sandy. The Small and Medium Business Procurement Program, receiving $79.9 million over 5 years, is set to level the playing field for small and medium enterprises. This support could help smaller builders and mortgage brokers break into federal projects, increasing competition and innovation. It's an opportunity for SMEs to play a more significant role in the housing market.
Absolutely, Steve. By supporting Canadian businesses, the government aims to insulate the housing market from global supply chain shocks and trade disruptions. This has been a vulnerability for Canada, especially during recent economic turbulence. However, the policy's full impact will depend on its execution.
Execution is crucial, Sandy. The Business Outlook survey from the Bank of Canada shows that business sentiment remained subdued in the third quarter of 2025, with trade tensions and tariff uncertainty affecting investment and hiring plans. Exporters in the steel and aluminum sectors, for instance, have reported weak outlooks due to these challenges.
While some exports have been redirected to Europe, this isn't a sustainable long-term strategy, according to the survey. The Buy Canadian policy aims to address these challenges by focusing on domestic production. It's clear that the future of Canada's housing market will be built with Canadian hands and materials, offering new prospects for mortgage professionals and homebuyers alike.
Indeed, Sandy. If executed effectively, this policy could be a game changer for the housing market. It's about building prosperity at home and ensuring that Canadian businesses have the tools they need to succeed. It'll be interesting to see how this unfolds in the coming months.
Let's talk about the recent rate cuts by both the U.S., Federal Reserve, and the Bank of Canada. On September 17th, both central banks reduced their interest rates by 25 basis points. The Federal Reserve's rate now sits in the range of 4.00 to 4.25%, while the Bank of Canada's rate dropped to 2.50%. This move comes amid reports of weakening labor markets in both countries.
Right, Sandy. The Federal Reserve's decision was influenced by a soft August job report and signs of rising inflation. Despite inflation running hotter than the Fed would like, the weaker economic backdrop provided enough reason for them to make the cut. According to TD chief economist Beata Caranci, the Fed's focus is on balancing the risks while supporting the softening labor market.
Similarly, the Bank of Canada's cut was prompted by consecutive job reports showing job losses, with the unemployment rate rising to 7.1% in August. While inflation in Canada has decreased from its pandemic high, it still saw a slight uptick to 1.9% in August. Economist Maria Solovieva from TD Economics noted that, even though shelter inflation has cooled, core inflation remains near 3%, which is above the bank's target.
It's a delicate balancing act for both central banks. The Bank of Canada's statement mentioned that the weaker economy and reduced inflation risks justified the rate cut. They aim to better balance these risks, especially with the ongoing tariff disruptions impacting trade and economic activity. Solovieva pointed out that the tariff shock is weighing heavily on Canada's economy.
For Canadians with variable rate mortgages, these cuts mean a greater portion of their payments could go towards the principal. However, those with fixed rate mortgages won't see an immediate impact, as these rates are typically tied to longer-term bond yields. In the U.S., similar dynamics apply, with adjustable rate mortgages seeing potential changes in payments after the initial fixed term.
And looking ahead, the Federal Reserve might still cut rates 2 more times this year, according to TD Economics. However, if inflation flares up due to tariffs or other factors, they could decide to keep rates steady. In Canada, TD Economics expects one more 25 basis point cut by the end of 2025, which would lower the policy rate to 2.25%, moving closer to the estimated neutral rate range.
It's certainly an interesting time for both economies. The focus remains on balancing inflation risks with signs of economic weakness. These rate cuts are attempts to stabilize the situation, but the full impact will depend on how these economic factors evolve in the coming months.
Absolutely, Sandy. The central banks are trying to navigate through a complex economic landscape, and their decisions will have significant implications for consumers and investors alike. It's crucial for mortgage professionals and homebuyers to stay informed and adapt to these changes.
Let's delve into the recent news from Hamilton, Ontario, where a home purchased for $875,000 in 2022 has been sold at a significant loss. This century-old brick house in the Strathcona neighborhood changed hands for just $490,000, marking a 44% decrease in value. This is a striking example of the current challenges facing the real estate market.
Indeed, Sandy. The real estate market in Hamilton has been under pressure, as reflected in the unadjusted benchmark price, which stood at $747,200 in October 2025. This is a 9% decrease compared to the same period last year. The Realtors Association of Hamilton Burlington's report highlights the broader trend of declining home values in the region.
It's a tough time for homeowners looking to sell. We've seen similar stories across Ontario, like a home in a trendy Toronto neighborhood, originally purchased for over $2 million, selling at an $800,000 loss. Another property in Brampton, bought for $1.6 million in 2021, sold for a $320,000 loss. These examples indicate a broader market correction.
Definitely, Sandy. The situation in Hamilton is indicative of a larger pattern where many properties are being sold for less than their purchase price. The case of the Hamilton home, listed multiple times in 2025 and finally selling after a significant price drop, underscores the challenges sellers are facing.
This particular property on New Street is quite charming, featuring 3 bedrooms, 2 bathrooms, and a kitchen that opens to a fully fenced yard. Despite its desirable location near Lock Street's shops and restaurants, the market conditions have overshadowed its appeal.
Real estate commentator Shazi Goli mentioned on social media that the owners had been trying to sell the home for over 6 months before accepting the loss. This sentiment reflects the frustration many sellers are experiencing in the current market environment.
It's a stark reminder of how volatile the real estate market can be. While the decline in prices might present opportunities for some buyers, it's undoubtedly a challenging time for those who invested at the peak of the market.
Absolutely, Sandy. This scenario highlights the importance of staying informed and making strategic decisions in real estate investments. It's crucial for buyers and sellers to consider market trends and economic indicators before making significant financial commitments.
Let's dive into the recent real estate data from Halton Hills, Ontario, where home prices have experienced quite a shift. According to the Toronto Regional Real Estate Board, the average price for a home in Halton Hills was $1.04 million in October 2025. This represents a significant drop of 14.3% from September 2025, but it's a slight increase of 0.8% compared to October 2024.
That's a notable fluctuation, Sandy. The market dynamics in Halton Hills are showing some interesting trends. The number of home sales was 62, with these homes staying on the market for an average of 24 days. Meanwhile, there were 252 active listings by the end of October, marking an increase of 20.6% compared to the same period last year.
It's interesting to see how different property types are performing as well. Detached houses averaged $1.14 million, which is a 16.2% decrease month over month, but a 5.6% increase year over year. There were 46 sales of detached homes, and they also lingered on the market for about 24 days.
Semi-detached houses, on the other hand, saw an uptick. They averaged $832,653, up 10.5% from the previous month, though they're still down 9.7% compared to a year ago. There were only 6 sales in this category, with homes selling after an average of 19 days.
Attached houses followed a similar positive trend with an average sale price of $890,500, up 8% from September and slightly up by 1.2% compared to last year. There were 4 sales here, with these homes spending about 17 days on the market.
Townhouse-style condos also experienced a positive shift, averaging $571,900, which is a 13.2% increase month over month. However, they're still slightly down by 0.5% year over year. There were 5 sales in this category, and these properties took an average of 29 days to sell.
Interestingly, apartment-style condos didn't fare as well. They averaged $540,000, down 16.2% from September, and a significant 31.9% drop compared to last year. Only one apartment sale occurred, and it took a lengthy 61 days to close.
These figures highlight the volatility and the varying performance across different segments of the market. It's clear that while some areas are seeing positive growth, others are facing challenges. The overall increase in active listings suggests a shift towards a buyer's market, offering more choices, but also indicating a potential for longer selling times.
That's a good point, Steve. The data compared to October 2015 shows an overall increase in average sale prices for all property types in Halton Hills. Detached houses, for instance, have seen an 81.4% increase in value over the decade. This long-term growth is significant, even amidst the current fluctuations.
Absolutely, Sandy. It's important for buyers and sellers to keep these trends in perspective and make informed decisions based on both short-term movements and long-term growth potential. The market's current state presents both opportunities and challenges depending on one's position and timing.
Let's explore who uses mortgage brokers today and why they're becoming more popular across different demographics in Canada. Historically, Canadians turned to mortgage brokers mainly when banks couldn't help them. But now it's a different story.
That's right, Sandy. People from all walks of life are seeking out brokers not just for necessity, but for the variety of options and personalized service they offer. Mark Tamburo from the Mortgage Center mentions that even the most qualified borrowers, who could get a mortgage from any bank, are choosing brokers to shop around for the best deals.
It's fascinating how this industry has evolved. Brokers today are serving a wide range of clients, including newcomers, self-employed Canadians, and those with credit challenges. They also cater to everyday borrowers who want more tailored solutions.
Exactly, Sandy. Rate shoppers, for example, are a big part of the clientele. Tamburo notes that his role has shifted from being compared to a used car salesman to acting as a financial advisor specializing in debt products. People come to brokers for advice, pricing alternatives, and unique strategies unavailable through traditional vendors.
And let's not forget the newcomers to Canada. They face unique barriers in purchasing a home, which makes brokers an invaluable resource. Rochelle Gregory from Merrick's Financial highlights how brokers can provide culturally sensitive services and connect newcomers to lenders who understand their needs.
First-time homebuyers also turn to brokers to navigate the complex process of buying a home. According to Mortgage Professionals Canada, 45% of first-time buyers and 40% of those aged 18 to 34 are likely to use a broker's services. They appreciate having options and financial advice beyond just securing a mortgage.
And it's not just first-timers. Many second, third, or even fourth-time homebuyers return to brokers they've previously worked with. Jason Nugent from Neighborhood Mortgage Source mentions that these repeat clients have shifted the broker's book from alternative lending to more traditional business.
Brokers are also crucial for those with credit challenges. They can help clients rebuild their credit profiles and find alternative lenders willing to work with them. As Nugent points out, the Big Five banks aren't set up to assist these clients, but brokers can provide the necessary options.
Self-employed individuals often find brokers particularly helpful, given the unique challenges they face in proving income. Brokers offer solutions with alternative lenders that consider gross earnings, unlike traditional banks that focus on fully verifiable income.
And let's not overlook seniors who are increasingly turning to brokers for reverse mortgages. With Canada's aging population, many retirees are tapping into their home equity to manage expenses. Brokers provide the time and expertise to guide them through these complex products.
It's clear that mortgage brokers are playing a vital role in today's market, offering solutions and guidance to a diverse range of clients. Their ability to provide personalized service and access to a wide array of products sets them apart from traditional banks.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Janine reads outro message, verbatim. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.